Grayson, welcome back to the podcast.
Yeah, great to be here, Andrew. Thanks for having me.
Yeah, of course. It's been a little while. I was just thinking about the last few podcasts that we've been putting out there, and we've talked about the US on some of these recent podcasts, but it's been with other asset classes, and it's been within the context of the US influencing their investable universe. So I'm happy to have you here and talk with someone who is investing exclusively within the borders of the US. And at the risk of, I guess, stating the obvious, Grayson, there's been a fair amount of political volatility from the US. And I think, we both know that's typically noise when we're viewing things through the lens of long-term investing. But the shift in things like global security or the domestic industrial policy, those changes are potentially structural. And so when you're operating within that type of environment, how do you distinguish between what could just be a political headline that may create either a short-term buying or selling opportunity versus a policy shift that actually breaks a company's thesis or provides a long-term tailwind to another one?
Yeah, there has been some policy shift, Andrew, and I think that's really the key for us is to figure out how it impacts things. Try to kind of step back to understand what matters and what's noise. It seems like the US has more of a short-term focus now, more focused on harvesting and extracting, that kind of mentality. So they used to be a bit more long-term focused, supporting capitalism globally, kind of the captain of team democracy or team capitalism, promoting global trade. So all these things benefited the US, of course. It wasn't just like altruistic that they were trying to push these. It benefited the citizens from deflationary prices, essentially. So if you lived in the US, and the US is a consumption economy, you could buy more stuff for better prices because it was made in China at lower cost labor than it would be if it was made in the US. So that was a pretty good tailwind for many decades. You've seen companies shorten their time horizon in the US too. And so I think there's been that shift where they're more focused on shorter term issues too. So a bit more of that harvesting mentality. And you've seen that with firms like private equity firms are kind of the poster child of this. And the government's doing the same. You've seen the government shift from, their R&D spending as a percent of GDP was close to 2%, 1.9% back in the 60s. And now it's 0.6%. So it's fallen by 2/3. Businesses have offset a bit of that, but the government and companies become a little bit more short-term focused in that. And that's just being kind of exacerbated recently. So I think, why is that happening? Well, globalization seemed to have enriched China, kind of like it enriched the US when it shifted from Europe and the UK to US, 100 plus years ago. It seems to be benefiting China now. And so I think the US is thinking about how do we kind of change this to shift the balance of power a little bit. And so they're becoming a bit more short-term greedy, trying to trade short-term earnings for potentially diminished long-term competitiveness. And so I think there's two things that's happening. One, they're trying to extract more. So they're trying to capture more of the economics out there. You're seeing that with things like tariffs, for example, and they're trying to minimize risk. And so that's things like moving critical manufacturing back to the US, whether it's steel, semiconductors, these kind of things. I think there's two risks for the US. For a private equity company, you have a risk that you increase prices of the good you're selling massively to kind of front end load a lot of the economics. And the risk is that, growth diminishes in the future, and you often put a lot of interest onto that company. And so you have high interest payments. And so you kind of extract a lot of the wealth early on. And then the people that own it in the future kind of suffer because they have low returns. And you're seeing anomalies in the US with that, where they're trying to extract more of those economics shorter term. And the risk could be some of their trading partners look elsewhere with agreements in the future, or try to become more self-sufficient or more resourceful. There's that contrast between the US kind of becoming more short-term and trying to extract more immediate wealth, and countries like China, who are essentially doing the opposite in many ways, where they're saying, hey, we can take advantage of this by having a real long-term view and say, yeah, let's become industry leaders globally over the next 20 or 40 or 50 years, maybe at the detriment of the next few years, but we'd gladly take that trade off of being a huge leader in 20 years. So you have those kind of battles right now between those two mentalities that are seemingly shifting in opposite directions. So, yeah, how do we invest in that environment? Well, I think the first thing is to just be more aware that the world has changed. And so you want to align yourself with companies that benefit from that kind of extraction mentality. And so, a lot of those are US companies, of course. They're trying to benefit their own companies and citizens. And so, as a US equity fund, you're generally aligned with that. If you're exposed to industries that are competing with the US, you might be in trouble. For example, if you're in the Canadian auto industry, it could be tough when they're trying to bring all the automotive manufacturing back to the US. Or if you're growing crops, you could be kind of in trouble there too if they want to grow those themselves. So that's just being kind of aware of that, and then finding companies that are less skewed to the old world, I think. So, the old world was globalization. There's a huge push towards that for decades. And the new world seems to be kind of more regionalization, potentially more kind of aggression and conflict. And so you may want to be less aligned with companies that are highly reliant on globalization, whether it's kind of manufacturing in different parts of the world or it's selling your goods to different parts of the world. Uh, and you may want to be more aligned with companies that are okay in a more regionalized world. So it could be companies like defense companies, domestic services, where you're kind of locked within the borders. Could be domestic products where you make them and sell them in the same country. Um, or it could be growth companies. Of course, there's some growth companies that always benefit for those. So those are some thoughts on companies that could be less at risk and more at risk.
You mentioned just the lens in which the two superpowers of today, China and the US, are viewing this. So it is going to be fascinating to see how this unfolds over the next 5, 10, 20 years. Again, with China taking a much longer view, not only how they conduct their affairs, but who is in power over a longer period of time in China versus the typical election cycle and administration changes that we see in the US. So I would imagine a lot of this has to be tempered as well as you move forward because you don't know which policies may reverse or change course in the next election cycle. I do want to dig into some of the themes, some of which you mentioned, but that are unfolding both in the market and in the portfolio, just to get a better sense as to how this is, how this thinking that you just outlined is showing up. And one of the drivers of portfolio performance lately has been, what we don't own. So one example is within the software space. You and the team made the call to exit some longer term winners like Adobe as well as Intuit last year. Just talk us through how things like valuation, management, assessment, or perhaps even just software's place in this age of AI factored into those decisions.
This is something we certainly followed the industry for many, many years, of course. We dug into it a little bit deeper over the past year or so, both to monitor some of these portfolio holdings, like the ones you mentioned, as well as others, but also to better understand what was changing in the environment. So a number of people on the team spoke with many different people in the ecosystem to kind of better understand this. What did we learn from that? Well, I think there's a few things. One is competition, two is penetration, and three is sentiment. So competition, we think this is being a bit underestimated by the market. So when you look back at the transition to the kind of software transition, the first phase in kind of more recent times was really the shift from legacy technology to the cloud. And maybe the technology was better in the cloud, maybe it's not. But what you saw was sometimes some of those legacy companies would disappear, but many instances they didn't. And so if you think about an industry like the payroll industry that had been invested in, there was historical payroll companies like the ADPs of the world or Paychex that people might be familiar with. they evolved and released cloud products. But then there's a bunch of new companies that also came in. And these are kind of the Paylocities, Paycoms, and many more. And so what you've seen over the last decade or two is that there's been a big increase in the number of competitors there that are offering pretty similar products. And the new companies are starting to get big enough where they're really becoming tougher competitors now. And so I think that's a bit of what you're seeing there is being underestimated. And then now you've got the kind of second phase of that, perhaps, which is the AI angle, which there's some perhaps another competitor or multiple competitors added to the mix, more of a kind of general purpose competitor than a kind of niche competitor. But you saw that with companies like Adobe, which we exited, where Adobe, of course, is great at doing things like Photoshop that people are kind of aware of. Um, but the risk was that AI was actually pretty good at doing that, especially kind of more simplistically, which could benefit some small businesses. Like if you've got a small business online, you could certainly create some kind of ads or graphics that you could use to sell your products online with AI in the near term. So I think that's the first phase, that competition, both from more players, including the cloud players, and now you're getting even more players with AI that are kind of doing the same thing. So that's tough. The second angle is the kind of penetration angle. And so our view is that's a little bit higher than you think. And so think about software like um, CRM stuff, like customer relationship management. So many people be familiar with companies like Salesforce, which has been a massive company out there. They were founded in 1999, I believe, and so that's 25 years ago. And so when you think about, I think that's just emblematic of how they've been able to go from nothing to being just massive. Where there's many companies have Salesforce in their organization, especially kind of mid and large size ones, and smaller ones also have something kind of similar that they've implemented too. And so I think you're hitting a point with many of these technologies where a lot of people have implemented them. And so there's not that it's not as easy to grow anymore. And so you're also seeing that with things like e-commerce. Of course, many people order tons of stuff online now. And so it's not as easy to grow that ecosystem or digital ads. People are seeing digital ads on, YouTube, all these places now that are just much more common. It's a much bigger universe of than it used to be 10 or 15 years ago. So just tougher to grow for those companies. And then thirdly, I think there's a bit of a bifurcation, or there was at least, in the sentiment. So we sold Intuit, Adobe, Paychex at different times in the past because we saw that the valuations didn't reflect some of this risk, whether it's risk from AI, risk from other software companies, risk from competition. And so those were kind of great decisions. And those have since haven't performed great. There were some that kind of avoided that. They were perceived as winners out there. I'm thinking of ones like ServiceNow, where when we were speaking with people last year, it was kind of universally loved by everyone you spoke with. Hey, this is the best company out there. And of course, they do many things right. But you've seen the sentiment shift even for those kind of perceived winners now, and where a lot of those are down, 15, 25, 35% over the past number of months on fears of AI, competition, etc. So that's kind of what we're seeing that, I think the market's realizing some of this now and starting to reflect that in stock prices, and they're just not sure kind of where the bottom is, because you can certainly imagine that with heightened competition and then perhaps even a new, even tougher competitor with AI, it's hard to know when the time is to get back in. And we're kind of in that camp too right now. We're certainly monitoring a lot of these companies closely, but it's not clear that today is the time to kind of change the view and start investing in a bunch of these software companies.
Yeah, and I did want to kind of dig a little bit on AI, and you sort of tipped your cards on that a little bit. But for a while, it did feel like any company that mentioned AI on an earnings call just saw its multiple expand. But as you just mentioned, more recent periods look much more nuanced. In some cases, it appears there's a discerning eye on these stocks now, but you still are seeing kind of some headline driven reactions from time to time as well. So I guess to take your comments a little bit further, has the market shifted, or is it in the process of shifting from sort of this buying the hype to more of a show me the money type of phase?
Hard to tell, but it seems like there are signs that it has. I mean, I think you're right. I was on a quarterly earnings call last week for an insurance broker, and this business has very little to do with AI other than just kind of consuming it like a normal consumer might, and a few other nuances, but very, very low AI exposure. I bet over half the questions on the call were somehow tied into AI. And so it just seems like investors are singularly focused on this theme right now. But it does seem to be tipping a little bit. You're right. We've seen the share price for companies like Nvidia have been kind of flat for six months, just kind of around 6 months. So that says something. And I think what people are worried about is they want to see some sort of return on this money. I mean, you see huge numbers announced for capital spending for some of these big hyperscale companies. Think about Amazon, Google, Microsoft. So I think if you looked at the big five hyperscalers were, roughly $100 billion in Capex in 2020, and I think some estimates have them at $500 billion plus for just that small group of businesses this year. So that's a 5x spending in 5 years, which is huge. And so I think a lot of investors are hitting a point now where they want to see some sort of return on this. You're hearing some comments about kind of uncertainty whether you're getting the kind of returns you want to get on that money. Um, and you're seeing companies kind of back down a little bit from that. I think even Nvidia was talking about their relationship with OpenAI, and they had this kind of co-invest setup. And they were talking down, well, maybe it's not, locked in for sure. We can adjust it over time. And so I think you're also seeing these companies adjusting to this and being aware that investors are not as keen about these kind of huge numbers being thrown around anymore. So they're trying to kind of tread carefully too. So it doesn't mean that, AI is not going to be used or it's not going to be an ultra powerful tool. I think it's just people saying, well, should CapEx, be $500 billion this year or $300 billion? 300 billion is still an enormous amount of money, but maybe the extra 200 billion is not going to be productively spent this year. And so I think they're just trying to judge a little bit of that. And there seems to be uncertainty right now where the market's not unsure. They're not saying it's bad. It's a bad investment and it's clearly a poor return on investment, but they're not saying it's good. They're kind of in the middle and waffling now. And so I think that's where we are in the market. We've kind of shifted, like you say, from awarding anyone who says anything about AI to being kind of in the middle where they're just hedging their bets. Could be good, could be bad, but we're not willing to make a huge call on this right now. And yeah, that seems like a reasonable place to be.
And certainly the price action that we've seen over the last several years has given them afforded them that luxury too, because I know a lot of these investors have made a lot of money. They don't need to continue to double down in that space. Grayson, just before I let you go, one other theme that I noticed is really related to either national security or supply chain security. So while you were trimming back exposure to some of the software businesses that you just talked about, you were also deploying capital into companies that operate in the space of nuclear, defense, robotics. What's the common thread there?
Yeah, that's right. So yeah, we saw an opportunity a number of years ago in defense and nuclear. It seems like the world has become more kind of confrontational, unfortunately, and so we saw early signs of this when we first started investing in defense. It was just before the Russian-Ukraine war. It seemed like that sector was highly out of favor at that time, and our take was, "Hey, this isn't that bad a sector. It's protected. It's going to be supported." It seemed unlikely that there is going to be no conflict in the world kind of in the future, and that you could ramp down defense spending forever. And so our take was that sentiment was very low at that point in time, and that things were shifting. And so we added to our defense exposure back then. It worked out very well over the next number of years. We've added with a few different holdings. I mean, that was initially with BWX, which is involved in nuclear submarines and then kind of nuclear energy. We've added companies like CACI and Northrop Grumman since then. Companies like BWX too, when we first put in the portfolio, what we like about that is there's multiple ways to win with a company like that. And so, as you know, Andrew, it's something we try and lean on is not just trying to forecast, this path is going to happen for the world or a company. It's like there's many paths that could happen, and we like to be able to benefit from many different scenarios. And so with BWX, that was one of those companies that had multiple ways to win. And so it could be that the world becomes more adversarial and you need to build more submarines. They benefit that way. It could also be that we need more energy in the world for more electricity for things like data centers, AI, even heat pumps and ways to kind of fuel or to warm your house or cool your house with electricity rather than gas. And so we like that avenue too, where it had different ways to benefit from some of these themes that were happening out there in the world. And so that's been something we've kind of shifted to over the years, and it's worked out quite well for us. Robotics and infrastructure has been automation infrastructure has been another one, as you mentioned. What we were thinking about there really was we've seen a huge boom in AI, as we've been talking about. But what could be the next leg of growth down that path? And our take was, well, maybe it's using AI in the kind of more physical world. So kind of AI right now, of course, is just you can many things with it, but you can kind of plug in something in your computer and get an answer back. It tells you kind of information. It could also be used for things like autonomous vehicles, so that you're kind of using that brain, but instead of just getting information back, you're using that to move a vehicle around in the world, like you've seen with companies like Waymo that Google owns. You can also use that in robotics, in manufacturing, a service industry. And so, yeah, we've been trying to find ways to benefit from that, whether it's investing in companies that supply businesses in the medical industry or healthcare, where you might be using robotic equipment in surgeries for urology, for example. Or it could be things like making plants more automated. So thinking about things like an Amazon facility where, hey, they're extremely focused on trying to improve the customer experience. And part of that is going from 2, 3, 4 day delivery to next day delivery to next hour delivery. And so how do you do that? Well, you have to invest in things like machine vision so that you can have those packages roll down the line much faster and get them out on the trucks and get the trucks to your house sooner. Or it could be things like investing in robotics that help with pick and pack, where it's they take those packages from their warehouse and get them into the box faster, so they can get the box onto the truck faster. And so that can be done with people, but it can also be done with machines, essentially. And so, we're looking at companies that supply companies like Amazon to speed up this process. And so, yeah, that's been another theme. So trying to find ways to benefit from automation in the world over the next, over the coming decades.
Excellent. Grayson, always appreciate getting a chance to talk markets and the portfolio with you. So first of all, thanks for coming on. First, probably month and a half or so of 2026 has packed a lot into it already. So all the best as you navigate the rest of the year.
Thanks, Andrew. Good chat as always.